Hello and welcome to the Money Tree training series. In this video we will explore the differences and similarities between Easy Money and Golden Years within Total Planning Suite and Total Online. In case you are unaware, within the programs Total Planning Suite and Total Online, users have the choice between two different reports, each of which can be customized to include certain pages of the report. So after handling data input, users can choose if the client they are working on is more suited to one report or the other. The most basic way to think about Easy Money is that it is a goal-based system, while Golden Years is a cash flow-based system. Goal-based programs are more concerned with if the client is projected to meet the goals without running out of money, and if not, how to fix the shortfall. While cash flow-based programs are more concerned with being as precise as possible with the calculation of all cash inflows and outflows, and leave the analyzing and solving to the financial professional. To better understand the differences between the two and when it is appropriate to use either one, let's go into more detail about what assumptions each report makes. Easy Money, as a goal-based report, assumes that retirement is the primary goal for the client. This doesn't necessarily mean not working, but it does indicate a shift toward a different lifestyle where drawing money out of assets is okay. The difference between pre-retirement and post-retirement is important to understand in Easy Money. In the pre-retirement period, Easy Money ignores any surplus or shortage that results from regular income and regular expenses. In other words, if personal expenses are greater than earned income, the shortage will be shown in the reports, but not withdrawn from assets if it is pre-retirement. The exception to this is other income and expense, as well as educational expenses. If these occur pre-retirement, then the net other income or expense will be deposited in or withdrawn from the included assets. After retirement, then all incomes are netted against all expenses before coming to a shortage or surplus, which then is applied to account balances. If you aren't sure if your surpluses and shortages are impacting accounts, you can always look at the Retirement Capital Analysis Report. To think of this in a different way, during pre-retirement, the report only saves the money that the planner specifically marks as being saved, either in asset details as monthly additions, or in the retirement plan additions, plan maximization. Another major assumption to be aware of is that instead of paying the taxes incurred by an asset from general sources, each asset pays its own taxes. This reduces the amount that is reinvested and provides a more conservative estimate. Speaking of taxes, Easy Money only calculates the income tax due for the first year, then uses this information to project taxes for every other year of the projection, which will likely overestimate the tax rate for retirement years, again as a conservative estimate. In general, the assumptions Easy Money makes can be summarized as a worst-case scenario. For a reminder of Easy Money's assumptions, you can always read through the report page Goal-Based Planning that is included toward the beginning when you run the entire report. Golden Years, on the other hand, uses an optimized approach for its cash flow-based planning. Cash flow-based means that all cash inflows and outflows are netted together and always have an impact on the assets in every year of the plan. By optimized approach, we mean that the assets do not pay their own taxes by default. Taxes are seen as an outflow and thus are netted against incomes before any shortages go to the assets to be paid. Also, these taxes are fully calculated every year, including AMT, itemized deduction phase-outs, and lots more. The assumptions that make up Golden Years can be found on the report page Cash Flow Planning, again found at the beginning of the entire report. In addition to these assumptions, it is important to note that Easy Money is the report that includes a life insurance analysis and has more shortage solutions suggesting steps a client can take to make retirement successful. Golden Years has traditionally not had any shortage solutions. However, a solution for reduction of retirement spending was added in 2013, and other shortage solutions are planned. Easy Money was one of the original planning systems and is designed to use the classical planning methods used in the profession for several decades. The basic idea is to figure out how much money the client will need to retire, and if they are saving enough to meet that goal. This style of planning can work well for younger clients, when the advisor wants to have the system include several shortage solutions, or when the advisor needs to do life insurance analysis as part of planning. The goal-based style of planning came under scrutiny when Lynn Hopewell saw that planning for future goals doesn't really help someone who is living out that largest of goals, retirement. When looking at planning for those who have less human capital that they can invest, it becomes more important to accurately track all cash inflows and outflows so that they can be most effectively managed in order to help clients have a financially successful retirement. Accordingly, cash flow planning can be appropriate for working with clients in or near retirement. However, the detail of the reports in golden years, particularly around income taxes in future years, has made this an increasingly popular choice when working with clients that are very detail-oriented, regardless of their age. If you still have any questions about the assumptions, similarities, or differences in the Easy Money or Golden Years reports in Total Planning Suite and Total Online, please contact our support team over the phone or through email.